Hi, I welcome you all on my channel, An Evolving Mind of Compliance. Today, I would be speaking more on FATCA and CRS. These are the two very important uh, tools to gauge the individual or the company tax applicability in the account maintained by the banks or the financial institution. See, first of all, we have to understand that these two things, FATCA and CRS, are linked to the predicate offense. The predicate offense of tax crime. The people are evading taxes and they are simply passing the value to other countries, the heavy amount of money to other countries just to avoid paying taxes. So this is very prominent regulations that require the financial institutions and the other custodial institution, depository institution, insurance to report the account being maintained by them. However, this has been a very simplified procedure for the financial institutions to follow. However, certain institutions, certain organizations make it complicated, but it is a very simple. But it has got linked with predicate offense, and tax crime is one of the major predicate offense where the authorities, where the governments across the world are very much concerned, particularly the G7, the G20, all are very much concerned about this tax evasion which is taking place. First of all, I will give you a little brief about the tax evasion and tax avoidance. The tax avoidance is within the legal framework. When you are able to avoid the tax by doing certain expenditures, maybe in certain countries, if you do certain expenditures over certain charities, that much of amount is reduced from your taxable income. So that's kind of a tax avoidance. The tax evasion means the money which is to be paid the tax upon has been sent out, or there is a capital flight in it. So that kind of a thing, the tax evasion is to be avoided. Therefore, the countries come across, they sat across the table and enacted certain laws. Somewhere around 2009-10, the FATCA, Foreign Account Tax Compliance Act, came into the picture from United States of America. Today, and then later in 2013-14, the CRS, Common Reporting Standard, came into the picture, which is almost similar to FATCA CRS. But today, I have already in my previous two videos discussed about the certain things about FATCA CRS. Today, I should be focusing a little bit more on CRS and the difference between the FATCA CRS and how the reporting could be made little easier. So that would be my focus. I had on my this iPad the little bit of presentation which I have prepared. So first of all, like FATCA is a bilateral agreement, means between USA and the country. But in case of an CRS, it is a multi-country agreement. Multi-country agreement means there are there are 115 or more than 120 participating countries which have signed an agreement between each other that they would be sharing an information about account being maintained by them for a reportable person or an entity. So, like Australia has sending jurisdiction where they have to send the information. There are around 77 and receiving from where they have to receive the information that if any Australian being maintaining the account in the country that is to be supposed to be uh, sent to the Australia is in 106. As we are in UAE, the UAE has only the sending information because fortunately we do not have the personal income tax or the tax now the corporate tax have come into the picture, so there may be the possibility they would be receiving the information from the other country. So as of now there are 76 countries where the UAE has to send the information about the account reportable account being maintained by the financial institution in UAE, and there is none, zero, as a jurisdiction where they have to receive the information because as of now the country was tax-free, but as the tax is coming up, corporate tax started, so there may be the possibility for entity they may start receiving the information from the respective jurisdiction. So that's about how the CRS is all about. Now I should be talking more on the differences which are very important, and the people are quite confused about those differences. So I have prepared a one small difference presentation, and I shall be discussing with you. But first of all, I should say that it has to be a very simple thing, very simple thing. First, be it a CRS, be it FATCA, you need not to have the FATCA CRS form for the UBOs as long as the entity, particularly the entity, is active active entity. So in that case, you need not to have the FATCA CRS of UBO. Unnecessarily collecting them is increasing your burden and increasing. See, I tell you the certain mandatory fields which are to be there in the CRS form. It has to be first of all very simplistic. So the only in individual account there should only be name, date of birth, residency address, country and countries of tax residency, tax identification number. And please note, there are very few countries. I think there are almost one or two countries where there will be a multiple tax. Let's say, for example, at this point of time, I can't be tax resident of a two different countries, except very few, where even if you live for a month or a two, they make you a tax resident of that particular country. In only in those circumstances you become the tax resident of two countries. As long as I am living in UAE for more than 180 days, I become the tax resident of UAE. I am not the tax resident of any other country. So accordingly, we have to decide. So there is a confusion that people are at times collecting the documents from both the countries, but people are not tax resident of two countries simultaneously. That's very rare exception. So, countries of tax identification number. So that is there. It is the first of all we have to collect the tax identification number and everything only from the reportable person. For the non-reportable person, we need not to even collect anything. Only for the reportable person we have to collect. And so these are the only points which we need to cover in the CRS individual form. So it shouldn't be made very complicated, and it should be easy. Particularly now comes the company account, corporate account or entity account. Entity name, country of incorporation and management, head office is different. So that is there. Entity address, country of tax residency of the entity, that particular comes into the picture of an offshore account where they are maintained and all those things. In my previous videos, I have already explained how offshore account will be treated. Tax identification number and entity classification. It's all things will be available in your AML, KYC details and all those things. You can get it and you can take a simple form. These are the only mandatory fields which are required of the CRS perspective. Entity name, country of incorporation, entity address, country of tax residency, tax identification number, and entity classification. So don't make it complicated the things. And and as in financial institution, we simply the self certification has to be declared by the customer. We simply have to have validation of that self certification. As in financial institution employee, we only have to have uh, a validation of the self-certification. We would be fined only if we have failed to conduct the validation based on the documentary proof. That's all. If it is if the certification is wrong, then it is the customer's liability. They would be fined. So you need not to bother about that. So that's there. So now I should come across the little bit differences of the FATCA CRS. For as I've told, it is FATCA is for the US person and CRS is for the person those which are part of the participating jurisdictions. So that is there. See, there is one major difference in the concept. The non-participating foreign financial institutions. Here, the foreign is for the financial institutions which are outside the USA. I am talking about FATCA as of now. I am telling you the difference. So, in case non-participating foreign financial institutions, let's say, for example, you are into the jurisdiction which have not signed an agreement with the USA, so you become a non-participating foreign financial institution if you are operating out of that jurisdiction. Under those circumstances, any revenue being generated by any company in that non-participating financial institution or by financial institution, it will 30% withholding of the tax would happen. It is as simple as that. If you, like in India, for example, if you don't give your PAN number, if you don't give your tax identification number, if you don't sign 15H form or 15G form, etc., then by default, the bank deducts TDS at the rate of 30%. But if you give it, then they may deduct it at 10%. So it is almost on a similar lines. If you are a part of a non-participating foreign financial institution, you have not signed an agreement, straight away on the revenue being coming from the US, they will deduct the 30% withholding. But in CRS, no as such the case. So there are two type of models which exist. It's both in uh, what you call CRS. CRS is all multilateral and FATCA. There is Model 1 GA and Model 2 GA. UAE follow Model 1 IGA because Model 1 is where the government has signed an agreement with IRS and the government regulates their financial institution. We as financial institution have to submit the data to the respective regulators of the country. They will submit it to the IRS. So similarly, in competent authority between the participating country, that is again the same in case of an CRS. The main difference comes is uh, I am talking about a special rule here, which there is a difference, little bit different. This is called de minimis rule. De minimis rule. In US FATCA, you have to make any account reportable if the balance in case of an individual account is $50,000 or more than that. And in case of an entity, it is 120, 50, 102, $250,000. It it is only for pre-existing account. The de minimis rule means, let's say, for example, the pre-existing account exists and you are not able to get the information from the customer, then the de minimis rule can be applied if the balance in case of an individual is lesser than 50,000 and in case of a company it is lesser than 250,000. However, in CRS, it is only applicable to the entities and where the balance is lesser than 250,000. So this is the very important because certain organizations struggle for pre-existing account. So that is there. So active NFE, only the NFE based on their registration, where in which country they are registered. We have in case of an inactive NFE, even if the UBO is US person, let's say for example, we need not to report it. And similarly in CRS, active NFE are not reportable. It is reportable only, let's say you are opening an offshore account, let's say an Indian company, and you are opening an account of an Indian company in UAE and they are operating out of India. In that case, this particular act, although it's an active NFE, it will be reported. Only in case of a passive NFE, you have to report the company and their UBO based on their tax residency. So that is the difference. And this is the and there is a difference between undocumented account. For example, in pre-existing account, the undocumented account where we are not able to collect the information and they exist in a pre-existing. In FATCA, it is only when there is a change in circumstances you have to apply. But in you have to apply the due diligence. But in CRS, you have to continuously apply to collect for the undocumented information. Even if your relationship manager is able to get some information, that is to be applied into the account. So the undocumented account in case of an CRS is only for the individual. Account which exists prior to the 1st January 2017 will be considered as the existing account, and only for the individual account you can consider them as an undocumented account in case you are not able to collect the FATCA or CRS, tax identification number or date of birth. and you can report, and you have to report it to the authorities as an undocumented account. So you need not to bother about this. Certain means to make little reporting little easier, I should give you certain points, reporting tips, I should call them. With respect to recorder that is pre-existing account, there is no requirement of PIN or date of birth. In case you are not able to get it, you can report them, and but you continue to follow up with the customer. That's a place of birth is not required. The balance of account is determined of the last day of the calendar year. Means let's say here the calendar year means on 31st of December, what is the balance that is to be taken into account? For the closed account, the balance is need not to be reported at the time of the closure. Only then in case if that whatever the transactions have happened, accordingly you have to make the account reportable into the system. If it is reportable, you have to report the closed account, but the balance is not mandatory to be reported. So in case of a joint account, if anyone is reportable, the account becomes reportable and you have to report the entire balance again in case of, and in case of a minor account, the guardian, whosoever is the guardian of the minor, if it is reportable or not reportable, accordingly the account will become reportable or not reportable. So I will summarize the following things. That first of all, in case of an inactive NFE, you need not to report them unless they are registered outside the country. The active NFE, UBO, FATCA, CRS is not required. There are only few fields which are the name, date of birth, PIN number, address. That is the only thing which you require to incorporate in the individual FATCA CRS form. Similarly, entity name, entity principal address, management office, entity TIN number, and all those things are required in case of an NNT if it is reportable. Passive NFE, UBO, and FATCA CRS is required. In case of an undocumented account which are pre-existing in nature, for CRS only for it is applicable only for the individual account, not for the entity account. But you can report them as an undocumented account, and you can continue to follow up with the customer. And then the most important is de minimis rule. The de minimis rule is that for the all the pre-existing account in UAE, it is from the 1st January 2017, all the accounts which exist prior to 1st January 2017, you can apply the de minimis rule. For individual, it is $50,000 in case of a FATCA, and for entity 150,000. In CRS, for individual, there is no such relaxation, but it can be reported as an undocumented account. But in case of an entity, you can have the relaxation that if the balance at the end of the calendar year is not more than 250,000, it cannot, you not required to report it. So this is just a summary of podcast here as I have given. I have prepared some presentations, so I wanted to share with you, and I hope it will be helpful in your day-to-day working. And I request each and every one of you to please like, share, comment on this video so that I can bring more content and I can discuss more and more with you. It will encourage me and to share more such videos on my YouTube channel. And with this, I thank each and every one of you for listening to me. Thank you very much.